We all know from the home office too, it's the majority of clients will leave their advisor once their parents are handing that money off. And you want any excuse, any reason, any benefit to reach out to them.
You as an advisor still need to know how to have the conversation about AI with your client. Welcome everybody to Inside the Flows episode 5. I'm your host Iyassu, and I'm joined with our Inflows contributor Nisheet Patel. How you doing, Nisheet?
Good, man. How are you? Happy Friday.
Happy Friday. We always talk about the weather. How's it going? I heard in New York, Mamdani got all the citizens shoveling ice out the driveways. How'd that go for you?
Yeah, no, the sidewalks are clean. This storm was way better or not as bad as the one previously. So this is just an average winter storm. We're good.
Yeah, it's funny, as I get older, I always try to see like what I was doing differently when I was younger. And one of the things that I'm doing differently now is I talk a lot about the weather. It's actually kind of enjoyable to talk about the weather now. And
Sure.
I think back to my like old 20-year-old self and I would never talk about the weather. And I'd look at my older self and be like, you're an old fart. You're
Well,
getting old,
that's a
man.
California kid in you because growing up in the New York suburbs, this is our money making season. Middle school, high school, we were running around shuffling driveways and found ways to hopefully double, triple, quadruple our allowance. So we were always looking at the weather, hoping for storms coming.
So we have an exciting show today, and hopefully we'll get it out in the afternoon for folks who are done with the day and driving home, and I just want to have a good show to or podcast to put on as they pick up their kids and hit the weekend. But before we get into it, there's something really exciting that's coming up in a couple weeks, which is future proof.
Right.
And I know we've talked about future proof a little bit in the previous shows, but there is a nice user journey experience and going into future proof. And one of the things is doing your breakthrough meetings. And if you hadn't listened to the last show, one of the cool things about future proof is that they set you up on these kind of speed dates where you get to meet with somebody for 15 minutes and hopefully you talk for 7 minutes and they talk for 7 minutes. And then you see, hey, how can we help each other out or partnerships and all that good stuff. But before you can even do that, you have to fill out a profile and answer questions. And this week, the opt-in requests are due. And I was going to ask Nisheet, have you tapped into that? Have you finished your opt-ins? What's
Yeah,
your dating
I've
scene looking like at Future Proof?
I've started them. It's definitely, again, like you said, one of the unique things about Future Proof. What I love about it, it just takes the awkwardness away from networking because you're forced to do these speed dating things where you get, blocks of 4 to 5 meetings at 15 minutes each, go from one table to the other. I mean, there's literally hundreds of tables in that giant tent they set up. So I'm looking forward to it. I've gotten a lot of requests from RAs. That'll be exciting to talk to you independent advisors out there that are listening to this podcast. Love to hear from the advisors and see, what's top of mind for them. What are they looking at from tech stack? Why are they at the conference itself? Future Proof is a great place to meet fintechs, to meet asset managers, to meet other advisors. So yeah, I've got a slew of independent advisors requesting sit down. So I'm gonna comb through those later today and then start selecting them. And actually, I think the deadline is today. I'm looking at the calendar here, 27th.
Yeah, it is.
So by this afternoon, we got to get them in. So I'm looking to maximize that. We can talk about inflows and get to hear from the advisors. So it'll be fun.
Yeah, I think the opt-in is due today, but the requests that you yourself made are still coming up. So I think that's
That's right.
next week. So the nice thing about the opt-ins for the audience members that don't know, it's the people who want to date you. So they're the ones who made
Yeah,
the first move, which is great because then
we,
you,
we we can't get rejected.
yeah. But the ones that you requested are also in it. And surprisingly, Nisheet, I got a lot of independent RIAs request to meet me. So
Yep.
maybe we're doing something right on this podcast
Okay.
because when I first started Future Proof, I did not get many opt-ins, and maybe it's because I was new to the scene. But this year, I'm pretty blown away and pretty happy with
Yeah.
the amount of inbound requests.
I think the first time I went, I was getting a lot of inbound requests from vendors, fintechs, asset managers. So this is definitely, other side of the table and loving to get that advisor perspective. So I'm pumped.
Yeah, that's great. So yeah, if you haven't heard, I'll put a link in the description. Future Proof Citywide. It's happening in Miami. Cool thing is they're having the conference on the beach, so you'll be on the sand, which is amazing in South Beach. And hopefully we'll see you out there and give us a shout out if you want to meet up. Nisheet and I will be there starting that Sunday. So
Yeah,
Future
and we're gonna
Proof.
do we'll put in a plug, right? We're gonna do one of these podcasts from the hotel rooftop. So
Oh yeah.
we'll have a Corona and the pool in the background, and we'll be able to talk shop.
Yes, sir. So hopefully we'll see you all there in a couple weeks. Now, moving on to the weekly recap. So this was a really interesting week. We started out actually on Sunday. So for those that don't know, the week starts on Sunday and ends on Saturday. And there was a blog put on by Citrini Research that came out that pretty much shook the markets. And we're actually going to use that article, or it's actually a Substack. We're actually going to talk about that towards the end as our special topic. So we're going to skip Monday today and go straight into Tuesday. And Tuesday, we had some pretty big news. UBS appointed Lisa Golia. I think that's how you pronounce her name. Forgive me
It is.
if I if I mispronounced it. But they promoted her as the head of field for U.S. financial services, excuse me, U.S. financial advisors, and basically, Nisheet and I had been talking about some moves we saw out of UBS by the advisors because they changed their compensation grid, which is basically their bonus structure, and now we're seeing a shift in leadership, and essentially what UBS is doing is recognizing that, hey, we have this advisory team that we want to keep and support and grow from. And so having a new leader come in is a great way to kind of restart things and get things, stop the attrition and get things growing again. And so UBS is a pretty large shop and they cater towards, ultra high net worth clients. So it's really important to have their wealth management and advisory teams, running and gunning on all pistons and cylinders and whatnot. So did you check that out this Tuesday, Nisheet, that news that came out?
I did, yeah. And it's a little close to home because I'm familiar with Lisa's work. She was at Morgan Stanley when I was there. She's a great operations professional, operations leader. And even then, you could see, I was running field engagement for our platforms then, and we worked closely with her team. And she knew how to speak to advisors. She put out these fun little 90-second videos on operations, change management. And that's one thing when you talk to advisors, we mentioned the grid. There's really two pieces of cheese they don't want anyone from home office moving. One is the grid and compensation, how it impacts their wallet. And two is the branch operations itself. And so putting Lisa in that position at UBS, I think is a great move by their part. Their leadership recognizes that not only does she have operational know-how and is an awesome, superwoman when it comes to that, but she's got field charisma and can talk to advisors about not just how to run operations, but now lead them. And so I think it's a good move to show the field like, hey, we've got someone with operational experience now, running the field. Not to say they didn't before, but she's awesome at that. I've seen it firsthand at Morgan Stanley. So, kudos to UBS for recognizing that.
Yeah, that's great. And just on top of that, knowing the advisors, I think it's really important for audience members that don't know. The kind of analogy you want to think about is, getting a new boss who's never been in your industry before. It usually is not great. It takes a lot of time for them to kind of understand how things are going. And they may have a great pedigree, like they came from an Ivy League school and they have an MBA and all that good stuff. But if they haven't been in the space doing the same thing that you've done and now they're your boss, there's always that friction. So having Lisa with that background come in and being able to just, get off the ground running, that's a huge benefit to the UBS team.
Absolutely. You need, in our space, it's a small world. You need street credibility. You need to prove that you've done it before. So totally agree with you.
Moving on to kind of like the midweek, we saw that it came out on the Barron's article that Osaic took an equity stake in Bard Financial Services. And Bard has about $1.2 billion in assets that they manage. So these are more advisors that Osaic is bringing into the fold. And It was I looked into Osaic. I've heard of them, never really followed them. I didn't realize they have 10,000
Yeah,
financial advisors.
I was going to tell you, like, we were talking about UBS, like they're actually now bigger than one of the big four. Osaic, spun out of Advisor Group, which is all the IG, and they've been adding and aggregating and buying up shops. And this is that future model, where it's like quasi independent, but having some structure and economies of scale with the larger player.
Yeah, and why this is important for particularly the advisor audience of this podcast is that typically these kind of acquisitions, whether it's by a large shop like Osaic or just one who's really focused on just aggregating assets and firms right now. There's two different business models. There's the independent business model where they buy you and you still work independently, but then there's the W-2 model where they buy you and you're now an employee, and it's way more profitable for the purchaser of the, entity to move you into the W-2. That's where they make, a good amount of, profits off of the acquisition, and I believe that they're moving Bard towards the W-2, and they had some kinda cool, term, they call it, like, empowered independence,
That's
but
right.
that really is a W-2, employment, option for them.
Yeah, no, I think you're spot on with the structure. And I think what that's showing is Osaic moving a little bit towards, maybe the more traditional wirehouse profit margin model as opposed to just being a conglomerate of independent shops. But they're going to brand it a certain way, and maybe there's some practices that they can implement that still promote that independent advisor culture. But for sure, some of these efficiencies and margin improvements are going to come with that W-2 model.
Then moving on to Thursday, this is something that kind of hits home for everybody. 30-year mortgage rates fell under 6% for the first time since 2022. And that's great for home buyers who are looking to, who've been waiting since COVID to kind of buy a house. Freddie Mac pegged the average 30-year fixed rate at 5.98%. So just under 6%, but still it's moving in the right direction for families looking to, purchase their new homes. What are you thinking on the interest
Yeah,
rates or the mortgage rates?
that's the magic number is 6%. Anytime I've had a conversation with friends or family about buying or even refinancing, it's always been that 6%, right? Like look for it to go under six, and then you can start thinking about it. So for sure, it's a psychological floor that's good for buyers. I personally still think the issue is with supply. Um, you're not, whether you want to blame inflation, tariffs, employment shortages, uh, even some of these companies that want to keep their high margins and maybe choke the supply. But for sure, builders need to come back. I think a lot of what you're seeing and reading shows that supply and pipelines are still kind of lower relative to historic points. So it's great that the number's under 6%, and hopefully we can spur some development activity and get those home builders back and putting up homes.
Yeah, and I was also having like a thought exercise about this, Nisheet, as I was reading that article. As you're seeing mortgage rates start to kind of dip ever so slightly, and I put myself in the shoes of an advisor, and you have like, let's just say you had a client, they're in their 60s, late 60s or whatnot. They probably have kids that are in their late 20s or early 30s. Is this like a good time to kind of ping your client to say, hey, if not maybe you client, but hey, maybe your kid should start thinking about a house, and then use that kind of like conversation to kind of bring the kid into the fold. Cause I know a lot of advisors right now are worried about this wealth transfer and this losing clients because of the wealth transfer. And I'm wondering if like this could be a cool conversation to, kind of get their foot in the door with the children of the client.
Yeah, that's a great point. I'll tell you, from my seat in home office when we're looking at practice management, field engagement, you always want something good news to have your advisors reach out to clients and start the conversation. And when you can, to your point, when you can bridge it to even a second point that says, "Hey, let's get the next generation involved in this conversation too," that's just win-win, right? So advisors have happy news, good news to call clients on when they're talking about lower mortgage rates, and it's also an opening to at least have that conversation with that next generation and show that you're thinking about them, that you care about them, and maybe even build that relationship with them. Because as all advisors know, we all know from the home office too, it's the majority of clients will leave their advisor once their parents are handing that money off, and you want any excuse, any reason, any benefit to reach out to them. So this is actually a great time to say, look, rates under 6%. Have you been considering this? Especially if an advisor, has a referral system where they can even talk to a bank as well. So bring that solution to the table and expand that relationship with the family.
Yeah, and these advisors know, and I'm sure they've probably given some advice to the clients about, unfortunately, at some point you're going to pass away, and what are you going to leave behind? And you probably want to set up a trust, and these advisors probably know who's in the trust because
Yeah.
the house is probably in the trust, and so is the beneficiary is probably going to be the children. So this is a great way to start a conversation that could lead to future engagements with that next generation. So
Yeah.
I don't know, it's
These are
just
all
thought exercise. Yeah.
Yeah, these are always going to be tough conversations, serious conversations to have. So if there's something in the market that actually introduces a benefit, a good time, a good opportunity to look at a mortgage or look at a house, then that's all the reason to start that conversation on a positive note.
And then the other thing that happened on Thursday was Barron's released its Best Fun Families 2025 list, which has been going on for 20 years now. And for those that don't know, this is Barron's way of rating asset managers and the fund families that they provide for you or advisors or institutions to invest in. And they have their own kind of criteria. But Capital Group took the number one spot, which, for those that don't know, Capital Group is a massive asset manager. And they are, yeah, number one for Barron. So that was kind of cool to see. And I think they hadn't been in the top five over the past couple of years. So this is great to see them get bumped up to the number one spot. It's always good when you don't see the same names up there. And Barron's also gave Capital Group a commendation from moving away from the Mag 7 investments, broadening and diversifying their investment field, and that's what got them up to the leadership spot, to number one actually for the Barron's Fund family. So that was pretty cool to see Capital Group getting the number one spot.
Yeah, I'd say, in a lot of the roles I've had, Capital Group's always been a strong performer, a helpful partner and supporter of the field when it comes to education and helping just in general talk about what's out there from an investment perspective, from a business perspective. And I think you saw, 2025 was one of those years where as the market broadens out, you need that investment class of analysts and portfolio managers to go beyond just the Mag 7 or the low hanging fruit. And so those efforts and that experienced team there was rewarded for doing that.
Yeah, and Barron's is a pretty big publication. A lot of
Yeah,
advisors
people will
subscribe to
listen, of
that.
course.
Friday, there was some pretty exciting news. Nisheet and I were talking about this earlier. The Paramount bid for Warner Brothers won out. So, for those that don't know or haven't been following, Warner Brothers Discovery put itself up for sale, and there was a bidding war that was happening between Paramount and Netflix. And there was back and forths going on for a couple of months, and finally Paramount said $32. This is the best offer. I think that's $81 billion of total value, probably a little bit more because they have to pay the breakup fee. That
That's right.
it's like a $2.8 billion breakup fee that Netflix and Warner Brothers agreed to. But Paramount won the war. Tell me your thoughts, and she give the audience your reaction.
Yeah, I like it. I never saw the fit for Netflix. I know they wanted the studio and some of the library, but then they weren't going to take the legacy kind of old school cable networks. Whereas Paramount, I think, can can really benefit from both. Obviously, bring Paramount and Warner Brothers together. You've got a lot of content there. The studio is going to do great. And then you're now assembling, pretty solid lineup of old school cable networks. I know that's not the sexy growth story when it comes to content. Everyone wants to go to streaming, but if you can grab some of those core channels, people are still going to need those and want those. And so I just see this as additive to Paramount. They did a great job with Paramount Plus. They're growing subs there. Now they'll add some of these legacy Discovery Channel family with and CBS, et cetera, with CNN, and that, the news group may benefit from it, but then the studios as well. You're bringing two legacy, old school, great content studios together. And on the flip side, Netflix, I just thought it was an odd pairing and maybe showed a little bit of desperation trying to grab content. A lot of folks we're pointing at Netflix's advancement there to basically say, look, it's run out of growth and it's now just trying to buy things, which it never did before. So you saw Netflix stock up pretty strongly yesterday. I think the market's going to like it. I think Hollywood's going to like it. For me, at least, I always thought this was the best fit. So I'm glad it worked out this way, just from a content perspective. From a market point of view, I think Netflix is in a better spot. They don't need to spend all that money on this, and they should just kind of, in my opinion, kind of stick to what they're doing and continue creating original content and finding other ways to be innovative without just trying to, buy an old school company.
In the asset management world, whenever there was like a bidding war happening between, three parties, it was the party that won the bid always overspent. Like
Yes.
almost always overspent. And especially if they had to go to the debt markets and, leverage up in order to get that acquisition. It was always a drag.
Yeah, but I think in this case, and again, I'm not, a media analyst or anything, but from everything we've seen and read, it seems like if Paramount didn't close this deal, I don't know where they were going to go. I actually think this is going to be additive to their Paramount Plus subscriptions, and what the Ellison family's trying to do there is will work with this acquisition. So hopefully for them and their shareholders and subscribers of Paramount Plus, they'll see this benefit, expanded spectrum of content, and hopefully it'll work out for everybody.
The way I was thinking about it was more on the Netflix side, so it actually might be great for Netflix not to have spent 70 plus $billion on,
That's right.
this. They could spend it on new IP, right?
Yeah,
And yeah, go from I mean,
they'll
they've been
get
doing great.
they've been doing great. Even they'll get the breakup fee. Obviously, the market's reacting. Stock is up big, so market's a fan of Netflix staying the path that they've been on. I think there's other ways that they can innovate without trying to spend money on acquisition.
Yeah, the other thing is David Zaslav, or I think that's how you pronounce his last name.
Yeah, it is. Yeah,
He's the CEO of Warner Brothers Discovery that's just being bought. I mean, people are going to write books about him. Like he's going to be in these like NBA case studies for like how well he's done, starting from Discovery to Warner Brothers to Paramount, the amount of basically shareholder returns he's generated for his entourage is going to be studied for years. I mean, he's getting up there to like I don't say legendary status, but kind of almost like getting up there to Barry Diller and
yeah.
whatnot.
No,
So
he's living the good life, and you'll see him courtside at Knicks games. He's now a regular there, so he's definitely earned it now.
that's our weekly recap. I hope you all enjoyed that. We're going to move on to our more specialized focus topic for today, which I mentioned earlier. It was this report that came out by Citrini Research. It was called the Global Intelligence Crisis. Did you get a chance to read that, Nisheet?
I did. It was definitely interesting to me. Here comes again, this is not Barron's. This is not the Wall Street Journal. And it's very clear in the beginning of this memo, right? This is not a prediction or analysis. This is like a what if scenario. And sure, it's gloom and doom. To me, I almost was like, I can't believe the market reacted the way it did. And I guess maybe I can, because the Substack went viral. We know how impactful retail investors are, but honestly, Yasu, this is like if somebody watched The Terminator for the first time this week and was like, oh my God, like ChatGPT is going to turn into Skynet and everything's going to fall apart. Like, this is not quote unquote real, like this is not happening anytime soon. I know the memo quotes, what was it, like 2028, 2029, something like that. But
Wait,
yeah,
before we get into it though, let me just give a quick summary to the audience.
yeah,
I should have done this before, so that's my bad. So basically, this global intelligence crisis post on Substack was a scenario analysis about if you take AI to the extreme, and the development, like what it can it do to the economy if you stress test it? And this was kind of like a doom scenario. And basically, it said there would be a feedback loop that's destructive to the global economy, and AI would replace all these white collar jobs, which the U.S. economy is truly is dependent on them, on their consumption. So their income, high income earners losing their jobs, something like 65% of consumption is based off of 20% of the high income earners in the US. And then what happens after that? Like, what's the domino effect? Well, it's like people don't spend as much money. There's a mortgage crisis, and then you export that to global economies. Where I mean, it was kind of cheeky, but basically they were saying these Indian software engineers, as India is a huge export of software engineers, and these Indians are like basically competing with electricity now, like or the price of electricity. Like it really did take it to the extreme, but it shook people. Like I remember getting text messages from my friends in the asset management space saying like, "Did you read this? My job is in like jeopardy."
right. And for sure, listen, some white collar jobs will be in jeopardy. We're seeing a little bit of that now, maybe with like customer service or whatnot, but not all of them, right? Like if you call customer service, how quickly, I always say representative. I want to talk to a human. I don't want to talk to touch tone, fake. And this is even before real AI, right? So I think you'll have places where AI takes a white collar job and people will pay less for that service because it's more efficient. You'll have others that want the human impact story of that, and not maybe just have AI complement that person, right? So in asset management, for example, in our space, wealth management, there's certain things that AI is going to replace. But there are others where AI is going to help the person that's making those decisions, whether it's a portfolio manager or stock analyst. So I still think we're a little bit ways from there. I think people are going to jump on things and panic in the market. And when I say panic, not just downside, right? I also mean panic on the upside when people just throw money at things because of AI. So it'll be interesting to see. This is going to be a bigger story that's not going away anytime soon. And you look, for sure, if white collar jobs go away, we have to reimagine what the economy and society look like. That's a much bigger conversation. I'm sure people were thinking that when, you know, electricity was found, was invented, when people discovered electricity, when people, we had the industrial age, the computer age. Certain jobs will go away, but it'll help others. And it just, you hear some of the Sam Altmans of the world to talk about, hey, if AI is going to bring all this efficiency, we as humans will have extra time, whether it's to create content, art, figure out other things to do. But think about that 50, 60, we were just talking about Netflix, right? Like think about jobs from before. Think about how important content is now, because we as society have a lot more time, and content wasn't a necessity when we needed to do other things that were more important. So I just feel like there's going to be a shift, and that's too philosophical for here, but there's going to be a shift in what's happening in society. I still think it's a little ways away. I think for the short term, especially in our space and bringing back to advisor, we've talked about AI as a recurring theme on these podcasts. AI can help white collar advisors and folks in the asset management space, folks in the wealth management space. I don't see it replacing advisors anytime soon. And I certainly don't see it replacing larger swaths of white collar jobs anytime soon. But it is going to be a trend that squeezes some companies in a good way from an efficiency standpoint, and in a bad way in terms of headcount. And hopefully firms can take this in a way where we gradually replace that, right? We talk about advisor headcount being uh, expected lower anyway. And maybe this is an efficiency that helps.
Yeah, you just got me thinking, Nisheet, about and everything you said was well said. We do talk about advisor headcounts and how advisors are pretty much, you know, going off into the sunset. They are kind of aging out and trying to retire and, coming to the end of their succession planning. I do think though that you as an advisor still need to know how to have the conversation about AI with your client. And I think what's freaking people out is it's not just like the AI chatbot, right? The chatbot's pretty cool. You can ask it a bunch of questions. It's like a much more convenient Wikipedia. But
Yes.
when you get to that next level of agentic or AI agents, I think that's what gets kind of crazy in people's minds because that agent is what they're afraid of is going to replace them. And if you are an advisor and your client is, a high income, software engineer at Amazon or Google or whatever, like they have a fear inside of them that you need to be able to either alleviate or understand, at least talk to them on the same level. So I do think we can say that it's a little overblown that AI is going to take over every job, but I think there is value in understanding what your client is going through and understanding the fears that they have, because you're there to provide advice, you're there to provide help. That's your bread and butter, and trust and understanding are your currency. And so I do think though that at the minimum the advisor needs to have a good core understanding of what AI is doing to transform their clients' job
Yep.
markets. What are your thoughts
Yeah,
on that?
that's a great point, and we should actually link to that research memo when we post this podcast because we keep talking about AI replacing jobs in our space or replacing advisors. But you're right. Advisors need to get, and maybe this is part of our home office responsibility. Let's get the advisor in front of proper AI terminology and show them like what's really possible and make sure they're okay with their security and their role. Because you're right, clients are calling, right? Clients are going to call and say, "Oh my gosh, like I read this thing. What can you tell me? What's going to happen? Do I need to get out of the stock market?" And if the advisor himself or herself is worried about their job, they can't really do the best in talking to the client. So I would say advisors, really should read this memo, especially that the fact that it went kind of viral and everybody knows about it. If clients didn't call this week, they might be thinking better over the weekend. And you're right. I think we need to make sure advisors are on sound ground with their role and know where AI is impacting the branch operations and their practice. And then also, you mentioned like opportunities to reach out to clients. This is another one to say, look, this is in the news. Not only is this how it impacted your portfolio, but hey, let's talk about what do you think? How is this impacting your job? And I think that's a great and meaningful and important conversation.
Yeah, yeah. Thank you for that. So, if you're an advisor, talk to your clients. They're afraid right now,
Yeah, they
or at
definitely are.
least they will be afraid once they're able to see what AI can do to impact their job. Maybe not take their job, but impact their jobs. So that's pretty much it for our special topic. Now we move on to one of my favorite parts of the show. So Nisheet, what are you looking forward to next week?
So, this week NVIDIA earnings came out. What I'd like to see perhaps over the weekend or going into early next week is folks maybe digesting that a little more or reading what Jensen Wong had to say on the call. I love listening to him because he's so optimistic. And I feel like that when we get scared about, AI and Skynet, I like reading about the leaders in this space, whether it's like him or this morning, Sam Altman was on, they got an investment from Amazon. Some of these leaders in this space, I want to I want to see if they can ground people back and maybe some of the fear goes away. Again, irrational fear, right? Real fear, totally get it. Some of the irrational stuff that came out this week, I'd like to see early next week people move past that.
Jensen and Sam Altman and Zuckerberg, anyone who's in the AI hyperscaler space, they're like, everyone calm down, and they're just making like gobbles of money. I
They
mean,
are.
these are like $1 trillion companies, man. Like, hey guys, maybe there's a little disconnect here about the fear that's being created versus the amount of money you're making. This is great. If you're at one of those companies, you're having a great time, right? But yeah, for the other folks out there whose jobs are being disrupted or whatnot, it's not that great of a time right now. And I hope, yeah, I'm pretty sure somebody in the PR departments they're probably picking up on it. That maybe we need to do a little bit more than just calm the fears of AI. But yeah, yeah, I listened to Jensen's or I read his comments and whatnot, and I like how he tried to calm the waters and saying like, basically you're just gonna use. You're not gonna like if we have a robot that's using AI, like the robot's not gonna try to figure out, a new way to microwave things. The robot's just
Right.
gonna put the cup in the microwave and turn it on,
Yeah.
right? And then
Exactly.
you get to do other stuff, much more
This
value
is just
added stuff.
listen. This is building the railroad, right? You'll hear Jensen talk about layers of cake. We're talking railroads. Um, this is infrastructure that happens once in a lifetime. I really genuinely think that's what's happening, and of course, there's going to be fear of the unknown, um, especially when it comes to people think about robots. But I do think if we just take a step back, um, it'll show that we're hopefully moving into a new age that's more efficient, more productive, and gives people more time and freedom back in their day.
So that's it for this week. I want to thank Nisheet for being such an amazing contributor to this show. Thank you, Nisheet. Always love your insights. Always love your thought leadership. I want to thank the audience as well for being a great following, and don't forget to like and subscribe. And if you're a advisor or a wealth manager and you like what you heard, you can always join us on Inflows. It's just for registered investment advisors, broker dealers, asset management, our peers. And you can come in and join, and if you want to continue the conversation, we'll be there. And if you want to discuss with your peers, they're also on the platform as well. So come join us at inflows.com, and we'll see you next week.